The bull put spread is bullish to market neutral. It's also called the credit put spread. And again, the essentials to success are the same as any options strategy: picking the right strike, duration, environment, underlying, and knowing your exit strategy. The bull put spread is similar strategy to the naked put, but you are creating a defined risk, and that defined risk is the premium you received. A bull put spread is a strategy that collects the premium, and the seller of the put spread would like to see time decay and the volatility to contract as the underlying trades sideways or higher. So this is going to be a strategy where you can create defined risks so that you aren't taking theoretically insurmountable loss in your account. And it's also good for when you're trading IRAs. That's another thing. Forgot to mention with the call spreads. In IRAs, you have to have defined risks. So if you are trading in an IRA, look to use these defined risk strategies to generate income in your portfolio. You cannot sell a naked call and you cannot sell a naked put. It has to have defined risk. And implement when an investment to earn income with the limited risk to profit from the rise in the underlying or both. This is, like I said, another strategy that has been making people a lot of money over the past couple of years, is just selling puts and watching the market continually creep higher. The downstroke of a market just continuing to creep higher is your volatility and your vega just are non-existent, which makes an option seller's life miserable. All you have to do is take advantage of time decay, and that's not as much fun as taking advantage of the volatility contraction, because when there's fear in the market, volatility really spikes, and it usually spikes beyond reasonable expectations as far as I'm concerned. Fear is always great for a seller of options. It increases your probability of success and everything else. So the max profit, max loss, and break even on a bull put spread. The max profit is going to be the credit we received when entering the position. So it's going to be our short put, which is going to be our credit, minus our long put, which is our debit, the one we had to pay for, which is the one that creates our defined risk. So if an example of if XYZ is trading at around 53, let's say, then we would sell the 52 strike and buy a little bit below that, the 50 strike. Let's say that we collected $1.50 for our 52 strike, and we paid $1 for our 50 strike. Then our max profit would be that 50 cents in the trade. Our max loss occurs when the underlying is trading below the long put at expiration. So in this example would be our max loss would be realized as soon as XYZ trades below 50. And our max loss is the difference between the strike prices plus the credit we received. So in this instance, our strike prices were $2 apart. We collected 50 cents, so our max loss would be $1.50. All right, and our break even is when the underlying is trading below the short put by the initial amount received, our net credit. So when our short strike is 52, we collected 50 cents, and the underlying is trading $51.50, that is our break even, or the intrinsic value of the option is equaling the net credit, which means how much it's in the money, and it equals our net credit. And that's going to conclude. The options over in the beans are just going crazy. And the edamame pit, as I've been saying on Twitter, everybody gets a big kick about that because the city kids here don't know what soybeans are. They call it edamame. They know what it is, all right? Take that. Anyway, that's all I got for you today. If you can't take that, take it easy. Yeah.
Found a city. Just to prove our point, step in here, our escort. You did not know what
edamame.
Well, I didn't know they were soybeans.
See, there we have it. You are a master, Wolfman. You are the man.